Hello and welcome. This is Binam, and in this video I'm going to talk about single index model. It is going to be a short and brief presentation wherein I would like to show you how the real world data can be used to apply the single index model. But first I want to talk about the motivation, which is when we apply the Marquis portfolio theory to construct the efficient frontier lines such as this particular line, we need some parameters. So when we talk about two stocks in the portfolio, how many parameters we need? So when we are talking about two stocks, we need the standard deviation of first stock, standard deviation of the second stock, so that's 2, and then we also need the correlation, that's 3, and we would also need the return from the first stock and the return from the second stock. So we would need 5 different parameters. And in my previous video, you may have seen how we use those parameters to compute and ultimately construct the efficient frontier lines such as this. But when we talk about a portfolio, we will not limit it to 2 stocks. People invest in hundreds or even thousands of stocks sometimes, yes? So computationally, application of efficient frontier line then becomes very hectic, and you need large, very huge computational power. So that can be complex, whereas the estimation issues related to the portfolio theory, Harry Markowitz efficient frontier line, can be that limitation, that issue can be overcome if we apply single index model. So this is how, this is what I want to discuss, because as I said, if you want to find out how many parameters do you need in the case of the efficient frontier line, you can also apply this formula, and I'm explaining here for 20 assets you need actually 230 parameters. That's too much. So you can use the single index model, and it's basically a kind of regression approach in order to find out the risk. So here you can see this term, which is beta RM, which is return from the market, and if it is excess return from the market, then you are taking away the risk-free rate, plus the epsilon term is here. So together these beta I RM plus epsilon term, they are in fact talking to you about the overall risk, whereas this alpha term is not the risk, but it is an indication of return. So when I will be able to make something like this, I will come back and explain on these again. So without losing more time, let's go and see the real world application. And in order to do that, what you need is you need to download the data. So you may have already seen in my previous videos how to download the data using Yahoo Finance. So here in this case, I would need S&P 500 data, which is going to represent the market. So you just click this one, and then on the historical prices, what I have done is I've taken 5 years data. So I've clicked 5 years, and frequency I've left it as weekly. If yours is showing daily, you can change it to weekly, but even if you take daily, that doesn't matter. Then you can click apply, download the data, and you do the same for Apple stock as well, or one of your preferred stocks. Try to match the stock in such a way that you take the stock and you take the market index from the same country, such as here I've taken Apple and I've taken S&P 500, so they both are from US. So I've already downloaded the data just to save the time, and you can see it is here. Now I just need to compute the return, which is going to be new price divided by old price, take away 1, and I can copy it across. And in terms of excess return, what I'm saying is I want to find out excess so that I will have deducted the risk-free rate. So I need the risk-free rate. Now I can download it from Bloomberg, but just to save the time, I will just say Y-chart risk-free rate USA, and then I can get it here. You can see currently as of today toward the end of January 2021, it's 1.07, but I've got 5 years data. So what I want to do is take something else. So I will just take this 1.04%. So which is here again. This is just for example. So what I need is, in terms of access, that is what I need, access. So now I can drag it so it is also applied for Apple. So now I've got everything, so I can just double click. I've got this data. This is the access return, and on the access return now I can obtain my single index model. And one easy way to do that would be through simple XY diagram. So you can click here, XY diagram is here, and now what you can do is you can just create a trend line by clicking here, add trend line, and then you also want to display equation on chart, display R square value. So you've got them, which is here. So that's what you have achieved, and this is telling you a lot already. So first thing is this 43.34%, which is R square. As you may already know, R square basically represents the coefficient of determination. So R square here, I'll write it like this, R square is 43.4, let's say 43%. This means the changes in the Apple stock returns is 43, so this means 43% changes or variation in the Apple stock returns is explained by the market return, which is S&P 500. Okay, so this is telling you something very important in terms of risk. The 43% is a kind of systematic risk coming from the market, and the return variation in Apple 43% is therefore explained by the variation in return, that of S&P 500. This basically also is telling you that 57% return therefore is not explained by the market, and this is basically the when you are talking about single factor model, then this is not explained by the market factor. Okay, so not explained by the market. So this you can see, if you are just talking in terms of the single index model, then you can link it with the firm specific risk, okay, or also known as idiosyncratic risk. So that's a good interpretation that we can make from this R square. But other things that you can see here is this 0.048, which is the intercept or the alpha. So as I said to you before, alpha is not the risk, but it is basically talking to you about the expected return. And what it basically is saying to you is what is the value added when the market is neutral. So when the market is neutral, which means when it is 0, what is alpha? Here, the alpha is 0.0048. So that is the value being added. Sometimes it is also referred to as the skill of, as something that explains the skills of the asset manager who is managing the asset. So that's basically can be explained in terms of expected return, that is alpha. Now this beta is here, and the beta represents the sensitivity of that individual stock's risk as compared to the market, and which is here in this case is greater than 1. Generally, when it is greater than 1, the beta, it is telling you that the stock, generally speaking, is cyclical, and when it is less than 1, it's more of a defensive. So that's how a quick general interpretation of single index model can be made. So thank you very much for your time, and thank you very much for listening.